With the passing of the Secure Act 2.0, 529 plans are now more appealing than ever. Previously, 529 plans could only be used for higher education expenses, but starting in 2024, you'll have the ability to move assets from a 529 plan directly into a Roth IRA. Sure, there are some restrictions and conditions that need to be met, but this is huge news if you've ever doubted that the funds would be used for education. There's a good chance that you are wasting precious time that could be hurting your kids' or grandkids' future. Time is our most valuable asset. If you are thinking about your kids' or grandkids' future and wanting to help them with the financial burden that the higher education system brings, now is the time to contribute. 529 plans offer tax-free compounding, which means the longer you hold the money, the more time it has to grow. Each year you wait to save, you miss out on potential earnings and will have to contribute a higher amount each month to meet the same goal. Parents of a 4-year-old child looking to cover 100% of the cost of a 4-year in-state public education will have to contribute $200 more a month than if they had started when the child was a newborn. The point here is that tucking money away into a savings account might not be the greatest strategy for you. I'm Jacob Harkey, Wealth Advisor at Sweet Financial Partners located in Fairmont and Jackson, Minnesota. Our team has helped hundreds of clients not only retire, but also provide a legacy for their families. We've used our trademarked Dream Architect process to help hundreds of clients define what is important to them. So think about what is important to you. One way to enhance your legacy potentially is through education, specifically through the use of 529 plans. This strategy could allow you to see the benefit of your gifts and set aside funds for your children or grandchildren's higher education needs. A great resource to help you navigate your legacy is our latest book, Dream Architecture. Grab a free copy at dreamarchitecturebook.com so you can work on building your life beyond wealth. On the topic of legacy, here's an example that comes to mind. One family where the grandparents prioritized the grandkids' education and took every opportunity to give a gift they would contribute to the 529 plan. We even made it fun for them and provided a certificate saying Grandma and Grandpa made contributions into your education account for your birthday or whatever holiday it was. When it came time for the kids to go off to school, they were able to take out the funds and graduate debt-free. This is an ideal scenario, and there are things that we can't control, like the markets and the decision whether or not one will continue their education. If they decide not to go to school, the funds aren't lost. They can still be used for other things. And again, the passing of the Secure Act 2.0 offers you another layer of benefit if there's the possibility that the funds won't be used for education. You have the ability to transfer the funds directly into a Roth IRA. At this point, I'm going to share with you the 6 essential tips when it comes to 529 plans. You could receive a tax deduction. Some states offer tax deductions for 529 plans, and this doesn't have to stop in the college years. If your state offers a deduction of up to $6,000 of income, contribute that $6,000 of income. You may be able to use the proceeds of student loans to the 529 account each year. Then immediately use the funds to pay for your tuition or other qualified expenses. This trick can be especially useful for graduate students who may qualify to contribute income from their internships to the 529 plan. Even in the state of Minnesota, where the credit is capped at $500, if you miss this opportunity, you'd be paying additional state income tax in the years where you were eligible when you were already paying for school. You can use a 529 plan for K-12 education. If you live in a state with a 529 tax deduction and you're paying for private school, you can put funds into a 529 plan and cover those K-12 education expenses. This is actually one of the most underutilized 529 plans that more parents should be taking advantage of. Let's take this for example here. Private schools in the state of Minnesota average $7,525 a year, according to privateschoolreview.com. The lifetime cost of 13 years of schooling is almost $100,000. And there are potential tax savings the 529 offers that you could be missing. Again, this might not be for you, but wanted to put some context here with the example. You can also change the beneficiary. When you create a 529 plan, you designate a beneficiary. However, those funds don't have to be given to that specific beneficiary. You can change that to another child or a different grandchild. If one child doesn't need the funds, you can give it to someone else. I can't tell you how many times I've heard, well, what if Johnny doesn't go to school or he gets a scholarship and doesn't need these funds? Well, that's great. And we can use those funds for something else. Again, the Secure Act 2.0 offers even more flexibility with these funds. And a bonus here, you can even transfer the funds to yourself. While it may be crazy to designate yourself as a beneficiary, there are plenty of legitimate education expenses that people nearing retirement may want to consider. What I have personally witnessed in today's world, retirement isn't what it used to be. It becomes the next chapter of your life, and that doesn't mean just sitting on the couch. People are still active and learning new things, which is great. And what that means is you can use these funds to help yourself out. You can also contribute up to 5 years at once. In general, parents or grandparents can contribute up to $16,000 a year to a 529 plan. But there's one caveat. You can also contribute 5 years worth of contributions at once, which is $80,000. This can be beneficial to contribute a lot of money early in a child's life. That way, the money in the account can grow and compound for more than a decade and a half before the child needs to attend college. Let's say that you decide to max out your contribution when the child is 8 and never contribute again. Over the next 10 years, that $80,000 could grow to $136,000, earning a measly 5.5% a year. Again, there's no guarantees when talking about growth rates. This is just a hypothetical example. You can also use the 529 plans just to pay off student debt. Starting in 2019, you are now eligible to withdraw up to $10,000 tax-free for qualified student loans. So let's look back at the change of beneficiary example. Let's say kid 1 and 2 get through school and use their 529s, while kid 3 gets a scholarship. You now can use those funds set aside for kid number 3 to pay off some of kid number 1 or 2's student loans. Ask for gifts. I can't tell you how important this one is. With tax-free compounding, even the modest gift can grow over time and help reduce the amount your child will have to borrow to pay for school. Next time a friend or relative asks for gift suggestions, let them know about the 529 plan. Remember the example in number 4, that was a big example, but the gifts can still potentially compound over time. We talk a lot about legacy here, and for more insight on creating a legacy beyond retirement, watch Brittany Anderson, the president of Sweet Financial Partners, video 3 reasons to have a multi-purpose retirement.